Hey guys, welcome to another Ultimate Edge webinar series. This time, once again, with Dave Herbst from CMG Mortgage. Dave is what I consider the probably national expert on the all-in-one loan, which is a phenomenal loan product that we have talked about in the past. And Dave, thanks for joining us today. We appreciate you coming on board again.
Absolutely. Thanks for having me, John.
Thank you. So I know we're going to talk a little bit outside the box today. I'm going to ask you some questions and stuff, but for those people that maybe haven't heard about what the all-in-one loan is, how's it work a little bit so people kind of know what we're talking about here?
Yeah, sure. So it's definitely an alternative to traditional financing, and it's widely known around the world as an offset mortgage, which is a great descriptor to use as you think about this type of loan. The way it's structured is that it combines home financing and personal banking into one account. So that essentially allows a borrower to run their cash flow, their income. And if you think about it, there's no greater source or sum of money than our earnings over time. So as you run your cash flow through your mortgage, this is designed to actually offset your daily loan principal and therefore reduce your monthly and annual and total interest expense without locking up your funds permanently. So while it keeps you liquid, you accelerate the pay down of your mortgage and save a ton of money in interest payments.
Got it. Okay. So my analogy for this, Dave and I've talked a lot about this, is you have a checking account here, guys, and a line of credit offset mortgage, which is linked directly to that checking account. You make deposits into your checking account. The day you make the deposit in there, it reduces the principal balance on the HELOC. That day, they do an interest computation on that HELOC at the end of the day. So if you roll a lot of deposits through your account, you're doing interest computations on a lower balance on the HELOC. And over time, for people who have pretty good cash flow, it is dramatic what that does in paying down the mortgage. Does that capture it, Dave?
Yeah. Yeah, absolutely. I think one of the key points you just hit on, John, was the fact that it's computing interest daily. So, our biggest enemy as we try to reduce our exposure to interest cost and debt in general is what's called an amortization schedule. It's a repayment schedule, of course, and every single mortgage comes with one. HELOCs don't. There is no amortization schedule within a HELOC. However, most HELOCs that you would find out there today also don't compute interest daily, and they also don't work like a traditional checking account. This one does, and that's what makes the all-in-one loan so special, is the fact that it's recomputing interest daily and allowing you to remain liquid as you use your income to help reduce your exposure to interest costs.
Okay, got it. And Dave, what kind of properties can you do with this loan?
Yeah, this is available for multifamily homes and single family, so 1 to 4 units, typically residential lending. Condominiums, non-warrantable condos. You can use this loan to purchase a property. You can use it to refinance out of a current mortgage. You can also use it to finance owner-occupied properties, second homes, as well as your investment properties out there.
Okay, so all three of the properties, owner-occupied, second home, and investment. How many all-in-one loans can one single person have?
Yeah, we allow up to 5 in total. So it's an enormous opportunity, especially for those people who have a second home or even a few investment properties, to really create greater cash flow and also have an easier time funding further investments.
Got it. So Dave, we were chatting earlier about this particular webinar, and I'm wondering if you have any data, and I don't know if you do or not, so if I'm putting you on the spot, I apologize, okay, on the typical client or maybe some extreme clients or whatever that got this loan. And you know what, let me back up one step, guys, for people who haven't seen this before. There is a simulator we're going to talk about maybe in a little bit here, where you can go test drive the loan and see what your situation is like. And so that's probably one of the first steps you're going to want to do. But I wanted to let Dave give the opportunity here to tell us about actual cases of people who have this loan and maybe some of the experiences they had with it. Dave, do you have anything like that?
I do, absolutely. I prepared a few in advance here to kind of just share. Some of them are just really compelling. We get this stuff all the time from customers. And it's when we were able to take a few moments and read through it, it's it's very moving. I'll kind of start by giving you some understanding of really kind of customer profile, because I think that's pretty telling. The vast majority of those Americans across the United States that owe a mortgage today are demographically Gen Xers and baby boomers, right? So I'm one of them. I'm a Gen Xer. Folks that are in our 40s or 50s or 60s, and we've got a long way off to pay off our mortgage, and at one point in our life, we've got to deal with it. The average customer is about 50 years old on this loan. Great credit scores. Our average that we see is about 760. So really good credit. That's not the minimum, of course, but that's what we tend to draw in. We see cash flow positive customers really gravitate to this loan because, of course, that's how you benefit. It's your cash and the positive cash that you have on a monthly basis. A lot of people make the mistake too, John, I think, of making the assumption that this is only for the savvy or for the affluent, those people that are that are high net worth or high income earners. That's not the case. As we look at the income levels, it's very average. It really, matches what you would find with average incomes across the United States. Our average loan to value is about 74%. So it tends to attract folks with some equity dollars available, whether that's being put down for a purchase or refinance. But let me, with all that said, let me share with you a couple stories, if you don't mind. I'll bullet point through one of them, then I'll put one of these stories in the words of the borrower herself. Okay, so this first example is from a customer that wrote into us recently from up in Oregon, and we'll just call her Deborah. Her name is Deborah W. Deborah is actually an appraiser, so she works within the industry as an appraiser, and she reports that her income is not it's not high, it's average for the area, Southern Oregon, and she refinanced into the all-in-one loan just about 2 years ago. It was early 2018, and she reports too that she started with a balance of about $283,000. So just about 2 years ago, $283,000, she's paid down by $131,670 already in just 24 months. That's unbelievable.
Wow.
I mean, just take a look at a mortgage statement. You're barely, cracking or putting a dent in it, as you know, in the first 12 months and the first 5 years and even 10 years alone. So she is actually on track to have her home paid off in about another 3 years from now.
Wow.
She'd refinance out of a 30-year loan that she had 29 years left on. So just a life-changing, transformative experience for her. And in her words, she said, we were originally estimated to be paid off through the all-in-one loan in just 7 years. And that got us excited. We've paid down now by over $131,000. And I'm excited to report that it looks like it will be paid off in about 2 to 3 years. We love this loan. You don't hear that very often from traditional products, do you?
What's not to love about that story? That's phenomenal.
Cool. It's awesome. It's one of the extreme stories. Let me give you another one here, if you don't mind. This is from Gina J in Utah, and this is really a heartfelt story. And but I think it really helps showcase and highlight the flexibility and the reduced risk that this provides for customers. And you'll get what I mean as I read through this. In her words, we originally refinanced into the all-in-one loan in 2018 with a balance of $320,000 on our mortgage. We now have a balance of only $280,000. Wow. So a little over a year, right? And a line of credit amount available to us at $400,000. Not that we want to use it, but it helps us sleep at night knowing that we have access to over $100,000 at the drop of a hat if ever needed. And currently we are facing a situation I never thought or imagined, and we may need to tap into it. We found out recently that our daughter has severe scoliosis. Basically overnight, we were looking at needing corrective surgery. We spent many, many weeks researching options for her to have the best quality of long-term life and decided to move forward with the surgery, but it may not be covered by the insurance. In fact, the surgeon's fees alone are above $70,000. As a follow-up, she said, we are incredibly grateful to have the all-in-one loan in place so that we can afford the best medical care if the insurance doesn't end up covering it. It's very comforting, and I love it, and I can't say enough great things about it. I think it's that security understanding that you have the availability if in case. I don't think that we anticipate those emergencies, but one thing I want to point to, in 2018, it was reported that the number one reason for personal bankruptcy filings in the United States was medical emergencies, unexpected medical costs. Oh. And what greater way to be able to kind of secure or hedge the potential for those emergencies than having access to your home's equity dollars without having to refinance. So I thought that was a great story to share as well. I've got several others if we have time.
Well, let's trade stories here, Dave. So guys, we had a couple clients that I thought might fit into this storytelling mode that Dave and I were going to do. One, Mike and Sandy, Mike and Sandy are retired. I've done probably 3 loans for them in the past to get to their retirement step. This is their last loan, and they came looking for a 15-year fixed loan because they wanted to just pay it off as quick as they could. They have pretty significant cash flow. They fit the perfect description of the client that Dave just talked about. They would not probably consider themselves wealthy or sophisticated, either of those words, but they're sharp. And we talked about this, and we did a little simulator thing, and it showed that they're going to pay off their home in less than 5 years. They went, what? And so they got the financial planner involved. We did a couple, 3 conversations there. His comment on the second conversation was, wow, I think I might have to do this on my home, you know? And they moved forward with a loan. Another extreme, this is a retired couple, Sandy and Mike. Another extreme is a gentleman, I'll call him Mike for privacy purposes here. And he's an investor, and he has investment properties. And Mike is he's such a great investor. He's actually renting a house right now because he's getting such good rental income on the houses he owns. And one of them was in Seattle, and he said, you know what? And he took a look, and we moved forward, and he moved forward, and he closed on an all-in-one loan because it was going to pay off his loan in a significantly shorter amount of time than he was with the regular 30-year fix that we were talking about at that time. And as Dave pointed out, he has excess availability on the line of credit that's sitting on that little rental property. And remember, this guy's an investor, so he makes good use of that available credit sometimes when he needs to do something with another property or whatever.
Yeah. Incredible. It's just incredible. And it's very common. We typically see that the balance reduces across the board for all active all-in-one loans being serviced today by an annual percentage of about 12.4%. So, that's
wow.
It's about 3 times faster than a conventional mortgage would, right?
That's
and folks
phenomenal.
out of a 15-year mortgage will pay off even faster. If you have clients, John, if you know people that are actually putting extra money today towards their principal balance, they're probably, not putting a lot towards it because that locks up the money permanently. And
exactly,
that may be unsafe. And a lot of people don't do that. But even those folks that are putting a little bit extra, when they switch over to the all-in-one, they find that it accelerates the mortgage pay down even faster than what we see on average. So I love hearing those stories.
I know, great.
It really is.
Good. Oh, any more that you want to share with us, Dave? Feel free.
Love to. Yeah, I would love to. Absolutely. This also comes from a couple in actually Arizona, and I'll just bullet point this one really quickly. We'll call them Mr. and Mrs. S. Okay. Mr. and Mrs. S refinanced into the loan back in 2007. So I love this story because it provides more depth, right, to the loan's history, and so that I think your listeners and audience can understand that this loan's been around for that long. And and it's not a loan that is just to benefit people in the near term. It's a 30-year open-ended, home equity line of credit coupled with that checking account. So it's very flexible and provides a lot of maneuverability over that extended period of time. And you can do some pretty special things with it, right? So this couple refinanced into it back in 2007, and Mr. Snyder was heavily invested in real estate projects. So a lot of buying in real estate and renovating those properties. And then the market hit us, right? The crash came in 2008, and things changed dramatically for them as a couple. As they write, unfortunately, our income suffered, and we had to change directions so that we could get back on our feet. They actually went 5 years without actually making a single deposit into their all-in-one.
Wow.
So, and because of the loan structure, you can do that if you've got credit available and you've spent time paying it down. So 5 years without doing anything. The interest cost, as you know, the interest payment is just drafted automatically at the end of each month on the 21st of the following month. And so, yes, they let their principal balance drive upward to pay for that interest. But here's the key point here. They didn't go late, and they didn't have to foreclose on their home. So it became something that was exceptionally safe and reduced the risk of losing their property while they got back on their feet. And in their own words, they write, we got the luxury of time with this loan to get back on our feet. It's incredible. And I would advocate this loan for anybody. So a lot of people are pretty passionate about it because we think about all the good with it, right? Just pay down, pay off fast. And that's sometimes even hard to achieve when you have your means, when you're living within your means and you're on track. the one thing I think we can all agree with is that life throws us all curveballs here and there, and being able to maneuver, through those periods of time in your life, I think is it's invaluable. You really can't put a value on that.
That's phenomenal, sir. That looked like it worked like an insurance policy for them in that particular case, didn't it?
It did. It did for sure.
Amazing. I love it.
Yeah.
Good stuff, Dave. So guys, I want to mention to you now, if you have interest in this loan, there's a couple things I want to make sure that are clear. One is that it's a full qualified kind of loan. It's for people who have good credit, as Dave talked about, the avatar of the client, good credit, income that we can verify, that kind of loan. You can do it, however, on owner-occupied second home, non-owner occupied properties, so a variety of properties. 5 loans, that's more than what it used to be. So obviously they're increasing what they're doing with this loan. Dave, what is the maximum loan to value you can do on a purchase scenario with an owner-occupied?
For owner-occupied, we'll actually go to 90% loan to value today, so just 10% down. So 90% to 850,000 is our maximum loan amount for 90%. If we need higher than that, we can go to a maximum of $1 million to 85%.
Okay.
Other than that, it's 80% is without MI. So anything above 80% loan to value will come with MI.
Okay.
It's not a monthly payment. It's only an upfront one-time fee, one and done, either through a lender paid option or a single premium that's paid for out of closing. Either way, once it's paid for, it's not something that you have to repeat each month and or worry about canceling. So 90% is our maximum today.
And if you're refinancing your residence, your owner-occupied home, what's the maximum there, Dave?
Well, if we're just paying off the current principal balance of existing loans, we can also do the same, up to 90%.
Okay.
If we are putting or providing some access to equity dollars, and in other words, providing credit at closing, right? So maybe the loan's payoff, your current payoff today is a lot less than your home's value. We could actually offer access up to 80% the value of that property for a line of credit. And the great news about that too, John, as you know, is that the closing fees are based on what's drawn out at closing and not the credit amount. So we're essentially providing access to equity dollars without having to pay for it as part of your closing costs.
Yep.
So 80% is the max for that.
Great tip, guys. I want to catch that. As Dave said, you can go 80%, but if you only pull out a smaller amount at closing, you don't go the whole 80%, it reduces your closing costs, which can be quite significant.
Yeah, and that's what we like to see. That's the
Dave, on a rental property, the investors, what's the maximum loan to values on those properties?
Yeah, so for a purchase and rate and term refinance on a non-owner occupied property, our maximum is 75% loan to value to $1 million. If we are going to go ahead and secure a line of credit higher than the current payoff, in our terms, that's considered a cash out. Even if there's no cash dispersed at closing, it's still, for underwriting purposes, would be considered a cash out. And the maximum for that for a non-owner is 70%.
Okay, got it. Very good.
Yeah.
And then, as I mentioned to you, if you want to test drive this loan, there is a simulator that the CMG, the lender, has that we have access to, and we can send you directly there. I found that the first time you're there, it's probably helpful if you're with one of us, one of the loan officers here, to kind of work through the process kind of thing. But then you'll create your own simulator. You have your own little password to get into it, and you can go play with it, and you can show it to your financial planner. You can talk to it with your spouse. You can change some of the parameters to say, what happens if we lose that income, and what happens if we do this and everything. And you can test drive the loan to see just how effective it might be for you.
Yeah, it's a comparison tool, and I think oftentimes people are pretty surprised that just in a matter of really 2 minutes, you're able to, compare the potential benefits of the all-in-one versus any other conventional product, and it'll be clear too if it's not, right? This is a financial decision, and it really comes down to the math and the logic, and not emotion. We should really be addressing the financial benefit or not. As you assess loan products, and not all products are suitable for every single household. And I think that's the greater point. There's no better way to test that than using the simulator.
Exactly right. Yeah, that great point. Not all products are for everybody, and this loan fits the people it fits well.
Right.
I don't know if I've ever asked you this before, Dave, so I'm going to once again spring something on you here. Do you have data to show that what people did with the simulator was what they actually experienced in real life when they got the loan?
Great question. We don't track simulations. We really have built this simulator to be really kind of a non-threatening way to analyze your own personal scenario. So we're not collecting, personal information, and you can store your simulation on our server indefinitely, but it doesn't require any personal information to do that as a user. And we also don't necessarily track the results, because what we find is a lot of people do go in a few times and change the numbers and really kind of address the hypothetical, what if situations and this and that. What if we do end up, pulling equity dollars out and renovating our property? What would that look like? Things like that. So it'd be really hard to tell, what's legitimate, and a starting point for most borrowers versus, the way they're going to potentially use it. But what we do is, in my own experience, I obviously track the principal reduction with our active loans, right? Active loan books, the servicing portfolio, that data is there for me. And as I mentioned earlier, the average reduction of principal annually is about 12.4%.
Right.
So substantial, right? Very accelerated. And when you run the simulator, most of the time, in my experience, the forecasts are a lot more conservative than that. We typically see a forecast for each scenario we run between about 6 and 9% reduction per year. So to know that in real life it's reducing even faster for people, I think is the reason why we get testimonies like the ones I just read, right? People are shocked in how fast it can actually lower the balance relative to what they were forecasting originally. So great question. I love it. I just don't have the pinpointed data in terms of what it shows in the simulator versus reality, but I can tell you in reality, the balance of these mortgages are reducing a lot faster than people would actually anticipate.
Well, that's pretty helpful. That's really great.
Great.
Got it. Dave, I'm going to give you the opportunity here. What are the questions that we haven't asked that you think are really pertinent that people might ask you that you want to talk about right now?
Yeah. I would say one of the most common questions we get, especially as people kind of digest, the information on this loan, we expect a longer gestation period with grasping, this loan, for lack of a better way to put it. It's not, this is not a loan for people to rush into. It's a financial tool, as you can tell by its structure. It's intended to get people out of debt, be a flexible, credit facility for the household, so they can go fund other financial goals more easily. So there's no rush in getting into it. And one of the questions we get during the process of folks analyzing it is, where's the downside? Where is the downside, right? I think people expect the smoke and mirrors or the catch-22 and a lot of these things, especially as it relates to mortgages, right? My answer to that, John, is that the downside would be for us to not take the time to test suitability. In other words, to get the wrong people into the wrong loan would get us all into trouble. And we've done, a very good job not doing that. The downside would be to put the loan somebody into this loan that doesn't have enough cash flow on average to really pay down the principal and save interest and benefit. Other than that, there are no prepayment penalties. There's no restriction on draw timing. There's really nothing built into this at all. It's not a fee-based account. I get asked a lot of the times too, does the checking account functionality come with a lot of fees? Is that how you guys are making your money? And no, it's not. This is a consumer-centric account. There are no fees for usage. In fact, ATM debit fees that you might incur by using the ATM card are reimbursed automatically each and every single month right back to the account. It's built and designed to help borrowers reduce their exposure to interest, but they've got to be cash flow positive to really benefit from it. And that would be that's my answer to that question.
Great question. Appreciate the answer very much.
Yeah.
Guys, so Dave is the vice president of CMG. He is not the guy you're going to call for a loan, okay? Dave is the guy I call because I have his cell number when I have a problem on a loan and I need somebody with, that knows what they're doing and within the structure there to help us out. And he's very helpful in that. He also has a staff of people. The people you will call a loan is a loan officer with Pacific One Mortgage or any other mortgage broker that they work with that you may be affiliated with. Our goal, as you know, with these webinars and when we chat with you one-on-one, is to educate you to the right product that is best for you, give you the knowledge so you can make a good decision, in this case, a simulator run, stuff like that, and help you out to make the right decision. We believe that, like Dave has been saying here, that pretty much all loans are financial tools to get you to where you want to go. And most of our clients are interested in building wealth with real estate, and this tool fits right in there. It's for a particular segment of the market. I hope we've captured that pretty well for you here. But if you do have questions, reach out to any of the loan officers. I'll have the contact information on the screen on the YouTube video that you may be watching later on, and feel free to give us a call. We're happy to help you out, and if we can't help you, we'll direct you to some loan officer that may be licensed in your area that can help you. Might be through Dave, you never know.
Yeah, let's pause for a second, see if anybody chats in there, and while we do, if that's okay, can I read another
I love it. Let's do it.
Great. This one comes from Cal and Susan D. And this story was actually submitted in by their mortgage broker. And so it comes from his perspective, telling the story about this couple. And I think it's also pretty compelling because I think also to your last question, Jimmy, which was, what are the common questions? What are the questions that people ask, and what have we not covered here? One of those questions a lot of the time is interest rates, right?
Yeah.
I think most of us gravitate to interest rates pretty quickly, if not first, when we think about mortgages. What's the rate today? And we're so robotic about it. It's conventionally kind of set in our minds, kind of somewhat brainwashed, I think. And the truth is, interest rates don't only or exclusively define our costs. In fact, interest rates, as you know, can matter less when you're able to really reduce your principal balance faster and easily, right? And that also shortens the lifespan of your loan. So the shorter period of time that you're in debt means that you're reducing your mortgage balance faster, which offsets the amount of interest you have to pay and reduces your effective rate of interest. So your APR could be higher, but you'll still spend less interest. One of the before I read the story, one of the comments that somebody made to me the other day, and it sticks in my mind. Does a pretty good job of summarizing this. You might be able to make the argument that just about every single mortgage across the United States today has a low rate, but borrowers don't pay low interest, right? So think about it just in those simple terms. Of course we don't. Hundreds of thousands of dollars in interest payments are committed on every conventional mortgage out there.
Absolutely.
Not a low amount of money, it's a lot of money. And so it's not the rate that's the issue, it's the terms of the loan and how your payment is reduced and who controls it. That's really impacting you more so than your loan's APR. So let me read this really quickly, because in his story, he has to remind his customers right before they close on the all-in-one. And of course, they grasp it fully. So this is Cal and Susan. They're both engineers. And so they asked a lot of questions. That's also in the notes here. This broker said, I love engineers for that reason. And so they design custom homes as engineers, and both earn very good money and are pretty conservative with their spending. 1 week prior to closing, they're all-in-one, they sent an email in and asking several questions. In fact, 25 questions listed out. And their first and biggest concern had to do with the interest rate. And here's the deal. They were continuously having trouble grasping the reality that they were agreeing to refinance out of their 3.5% 30-year fixed mortgage into the all-in-one loan that had a higher interest rate and was also going to be an adjustable rate for them. Right. So this broker said, I pointed out a couple of very important things. First, that they had 27 years left on their current loan, and they were hoping to retire in about 15 years. And because of their cash flow behavior, they were forecasted to pay off their all-in-one in just 2.3 years. So another dramatic, huge difference. So that would end up saving them over $300,000 as forecasted by the simulator, just using their income, right? The second thing he pointed out was that he said it didn't matter really what your rate was. You could have a 3.5%, a 5.5%, or a 7.5% mortgage. For your situation, he said, your income is more effective as a savings tool than interest rate alone. And so he said, when we got all their questions answered, Cal admitted that somebody of influence, somebody they trusted, was very skeptical and trying to get them not to move forward with the all-in-one, and was saying you should become more aggressive with your savings and your investing and keep that low rate fixed mortgage in place. That sounds better for you. And so the broker had said back, but where else? Think about it. Where else can you put the money that you're going to need tomorrow, the rest of this month, and forward for all of your regular spending needs and achieve a rate of return on those dollars equal to the rate on your loan, right? In the form of savings, interest savings. And at that point, he says that the wife spoke up and said, I hadn't thought about it that way. We're definitely doing this loan. Done. And they closed. And and sometimes it just takes that kind of a process to really kind of think through really the variables that add up, the costs. And again, interest rate has less of an impact than people really are led to believe, I think. And that's one of the big gimmicks in the industry.
Very good point. Very good point. Absolutely. Yeah, guys. So as Dave alluded there, this loan takes a little bit of checking into before you're going to wrap your mind around it, understand it, and maybe make to choose to step forward with the kind of thing. But we encourage that, and that's the right thing to be doing. Dave, one of the folks wants to know, is this loan available in all 50 states?
Great question. It is, all 50 states. Now, down in Texas, currently, it's only available for investment properties and second homes. So just in case any of your audience is down there, we hope to achieve a rollout for primary residences, referred to as homesteads, down there. There's some rules within their constitution that we've got to be careful about in terms of introducing a HELOC product that also functions as a everyday transactional checking account. So we're working through those items and hope to have that accomplished sometime this year. But to answer the question, in all 50 states.
Okay. So guys, Pacific Road Mortgage has loan officers that are licensed in more than one state, but not all. Okay. And more states coming. But if you choose to reach out to us, we're happy to chat with you about the loan. And if we're not licensed in the state that you are in, I typically just give your information straight to Dave or somebody on his team, and they will take care of you. So you don't need to worry about that. Dave, I don't see any other questions. Once again, man, great information. I really appreciate you taking time today to hang out with us and give us some information on the all-in-one loan.
My pleasure, John. Thanks for having us. I really do appreciate it.